All right, let's talk about one of the weirdest earnings reports we've seen this season. I'm talking about medtech company AngioDynamics, ticker ANGO. You look at the numbers and you think, wow, that's a home run. But then you look at the stock chart and it tells a totally different, much more confusing story. So let's try to figure out this paradox.
So here it is, the big question. You've got a classic beat and raise situation. The company comes out, posts numbers that are way better than anyone expected, and they tell Wall Street the rest of the year is going to be even better. So why on earth did the stock tank? I mean, it popped a little bit before the market opened, but then it just completely reversed and fell off a cliff, down almost 13%. What happened?
And this chart right here just lays it all out, plain as day. Look at this. They beat revenue expectations by a solid $3 million. They beat on earnings. Not just beat, they crushed it. Analysts were expecting them to lose 10 cents a share, and instead, they broke even. And then, bam, the stock gets absolutely hammered. That disconnect right there, that's what we need to dig into.
Okay, section 1, the beat and the drop. Let's start with the good stuff. What were the numbers that, on paper, looked so fantastic? This is the bull case, pure and simple.
I mean, just look at these headline numbers. They were fantastic. Revenue at $79.4 million, well above what Wall Street was looking for. Adjusted earnings per share, they hit 0, which sounds boring, but it's a massive beat when everyone was penciling in a 10-cent loss. And then you have adjusted EBITDA at $5.9 million. That's up 90% from the same time last year. 90%! You really can't ask for much better than that. And here's the really important part. This wasn't some one-off fluke. The growth was coming from their key products, their growth platforms. You know, the stuff that's supposed to be the future of this company. Auryon was up almost 19%. NanoKnife up over 22%. And AlphaVac was on an absolute tear, up more than 40% year over year. This is exactly what you want to see. It looks like their core strategy is really firing on all cylinders.
All right, section 2, behind the headline numbers. So, if everything looked so great, why did the stock get crushed? Well, the market clearly wasn't buying the story. So let's peel back a few layers here and find out what exactly spooked everybody.
And here it is. This is the number that threw a wrench in the whole thing. Tucked away in the report was a $1.4 million benefit. Now, where did that come from? It was a one-time gain from a deal they did in France. It's not something that's going to happen again next quarter or the quarter after that. And for smart investors, that's a huge red flag. It immediately makes you question the quality of the quarter's result.
Yeah, and this gets to a really important idea in investing called the quality of the beat. See, not all earnings beats are created equal. A high-quality beat is when a company is just killing it, selling more stuff, making more profit on each sale, sustainable, repeatable things. But a low-quality beat, that's when the good numbers are thanks to a one-time event, just like this France deal. The market is smart. It sniffed this out and basically said, wait a minute, this beat isn't as good as it looks.
So suddenly, you have two totally different stories being told in the same earnings report. The bull story is easy, right? The headline numbers were great, their key products are growing like crazy, and they raised guidance for the year. But the bear story is asking some much tougher questions. Like, was this beat even real? What's going on with the CEO? And are their profit margins about to get squeezed? That's a lot of uncertainty.
Okay, on to section 3, guidance and headwinds. So let's shift our focus to the future. What did the company say is coming down the pike, and what are the big challenges they're facing?
Let's start with the good news, because there was some. Despite how the market reacted, management themselves seemed pretty confident. They actually raised their forecast for the full year, for both revenue and for adjusted EBITDA. So they're basically saying, hey, we know there are some challenges ahead, but we believe the momentum we're seeing is real and it's going to continue.
So what are those challenges? Well, the first big one is a manufacturing move. They're moving production from their plant in Queensbury, New York, down to a facility in Costa Rica. Now, this is a classic short-term pain, long-term gain kind of deal. In the short term, it's going to hurt their profit margins because of inefficiencies. Things aren't running at full speed. But the whole point of doing it is to save a ton of money in the long run.
And then they dropped this. This was the real bombshell. Jim Clemmer, the CEO who's been there for a decade, is retiring. Now look, in the world of smaller medtech companies, having a stable, known leader is absolutely critical. The second you announce you're looking for a new CEO, you inject a huge amount of uncertainty into the story. And that kind of news can totally overwhelm even a fantastic earnings report.
So, section 4, the next call, our rating. Okay, let's put all the pieces together. You've got strong growth in the core business, but it's clouded by a one-off gain. You've got a guidance raise, but also a huge leadership question mark. So what's our take on all this? What's the call?
You can almost feel the tug of war going on with this stock. On one side, you've got some really powerful reasons to be bullish, right? The growth in their key products is undeniable. Management is executing well enough to raise their forecast, and they've got innovation in the pipeline. But pulling in the other direction are some serious risks. The CEO situation is a big one, the hit to their profit margins is another, and of course, those nagging questions about the quality of their earnings.
So when we weigh all that, our official rating here at the next call is going to be market perform. Here's why. The business itself is actually doing pretty well, but the stock is probably going to be stuck in neutral for a while. We think you're going to see a lot of volatility until the market gets answers to two big questions. One, who is the next CEO? And two, can they deliver another great quarter without any one-off accounting tricks?
And that brings us to our final section, the trade idea. Okay, so we've established there's a ton of uncertainty here, which means there's also a lot of volatility. So, for an experienced investor, how might you play a situation like this? Here's a thought. Let's say you actually really like the long-term story here. You believe in their products, Auryon, NanoKnife, but you're worried about all this short-term noise. Well, you could use that uncertainty to your advantage. One idea is to sell cash-secured puts. Basically, you're selling insurance to nervous investors. You pick a price way below where the stock is today, and you collect a payment, the premium, because volatility is so high. Now, if the stock keeps falling and hits that price, you have to buy the shares. But hey, you were willing to buy them at that lower price anyway. It's kind of like getting paid to set a lowball offer on a stock you already like.
This is not financial advice.